In the next slide, we will see that what will happen to a large group of similar individuals in any given time period can be predicted. Insurers call these groups risk pools. Insurance actuaries can use these risk pools to make mathematical predictions about the number and type of losses each risk pool will experience over a given time period. The number of insured units increases, the predictions of the actuary are more accurate. These predictions are very important because insurance companies use them to calculate their probable losses and to establish premium rates. Insurance companies need to set their premium rates low enough to be competitive, but high enough to cover claims, pay their operating expenses, and to make a profit. Insurance contracts are governed by the principle of indemnity. This principle means that insurance coverage attempts to restore an insured to the same financial condition enjoyed before the loss. If an insured makes a profit from their loss, the principle of indemnity has been violated. Overinsurance is a condition that results if an insured purchases an insurance policy that provides more coverage on a risk than the value of the possible loss. Insurance might also create a situation where they are overinsured if they purchase more than one insurance policy to cover the same loss. Overinsurance violates the principle of indemnity. However, insurance companies have methods to prevent overinsurance. We will talk about those later in the Insurance Fundamentals chapter. Insurance must exist at the time of the loss. With life or health insurance, insurance must exist at the time of the loss. If no risk of financial loss is present, no insurable interest exists, thus eliminating the need for insurance coverage. With property, casualty, or liability insurance, insurable interest must exist at the time of the loss. With life or health insurance, insurable interest must exist at the time the policy is purchased. For example, an insured can purchase a policy to cover his dwelling for loss from fire because he would suffer a financial loss if his dwelling burned. However, the same insured could not purchase a policy to cover his neighbor's dwelling for loss from fire. This is because the insured would not suffer a financial loss if his neighbor's house burned. Additionally, if the insured sold his covered dwelling and it burned after he no longer owned the home, he would no longer have insurable interest in that home. This is because he would no longer suffer a financial loss if the house burned because he no longer owned the home. Now let's review an example, using life insurance. An insured could purchase a life insurance policy to cover her business partner's life, because the insured would suffer a financial loss if her partner died. Therefore, the insured holds an insurable interest in her business partner's life that exists at the time she purchases the life insurance policy. What is risk? Risk is the possibility that a loss might occur. People buy insurance to cover their risk of loss. The loss can be of life or the loss of a family member in the event of death. There could be a loss of income due to accident or illness. In the case of property and casualty insurance, a structure may burn or a commercial truck may be involved in an accident. It is important to remember, for the purposes of your state exam, that not all risks are insurable. We have just stated that not all risks are insurable, so now we will review the characteristics that make a risk insurable. An insurable risk must be definite and definable. For example, the policy may cover fire losses to a home. This defines that fire is covered, so we can assume that flood would not be covered. The loss also must be accidental. Insurance does not cover intentional actions. The insurance company should be able to calculate the probability of the loss, and the law of large numbers should apply. The loss must be great enough that it would cause an economic hardship to the insured. It must be possible to offer insurance on the risk, at a rate that is reasonable enough that people can afford to purchase it, and the loss must not be catastrophic in nature. All of the characteristics we just listed are not required to be present for every insured risk, but most of them should be included whenever possible. The two main categories of risk are pure risks and speculative risks. With pure risks, there is only the possibility of loss. There is no possibility for financial gain. Pure risks are insurable. With speculative risks, the possibility of financial gain or profit exists. Speculative risks are not insurable. Most risks are neither completely pure nor completely speculative, so these two broad categories of risk are further classified as static risks, dynamic risks, fundamental risks, and particular risks. Let's discuss the first two of these risks on this screen. Static risks are historical factors that do not frequently fluctuate. They result from a static or unchanging environment. Static risk factors tend to be associated with long-term risks, such as an area that may only flood every 100 years, or a genetic illness that may or may not express itself. Static risks are pure risks because there is only the possibility of the loss. Therefore, static risks are insurable. Dynamic risks are associated with change. Examples of dynamic risks include a new and fatal virus erupting into society or technological advances that may cause a business to lose market share. Another example would be a change in law regarding hazardous waste disposal that now leaves a business liable for practices that were previously acceptable. Dynamic risks are not insurable. Fundamental risks affect entire groups of people or property within society. For example, floods, earthquakes, terrorism, and economic collapse affect large numbers of people. These fundamental risks are insurable through flood insurance, earthquake coverage, unemployment insurance, and other types of insurance that are heavily subsidized by the government or offered solely through a government agency. However, there are other types of fundamental risks, such as double-digit inflation, making the cost of goods too prohibitive to produce, or foreign competition forcing a business to go bankrupt. These types of fundamental risks are not insurable. Particular risks affect only an individual person or family. These risks are the result of a situation that occurs simultaneously with another specific event that increases the chance of a loss. For example, an insured family is at particular risk when they are at home when a burglar happens to break in. Ordinarily, an insured family being at home would not ordinarily increase their risk of being injured. However, being at home when a burglar breaks in increases the chances that they could be injured or killed by the burglar. Particular risks are usually insurable. Now let's look at the difference between a peril and a hazard. A peril is what actually causes the loss. For example, a commercial building catches fire and is damaged. The fire is the peril that caused the loss. A hazard is a condition that increases the probability or likelihood that a loss will occur. For example, a frayed electrical cord increases the likelihood that an electrical fire may occur. Now that we have covered the difference between a peril and a hazard, we need to review the different types of hazards. Physical hazards are the material, structural, environmental, or operational features of an insured risk that may create or increase the opportunity for injury or damage. For example, defective building materials are a hazard that may cause a building to collapse. Toxic chemicals used in the workplace could result in occupational diseases in the workforce. A slippery sidewalk or floor can cause someone to fall and break a bone. A moral hazard is a condition that increases the probability that a person will intentionally cause, create, or inflate a loss. A moral hazard is generally an act created out of intent and can be calculated or even premeditated. Stated differently, a moral hazard provides an incentive for one party to take risks that another party will pay for. Interestingly, insurance can actually create a moral hazard. For example, an insured who continues smoking because he has purchased a life insurance policy that will provide for his family if he dies from lung cancer or a stroke. A moral hazard is a condition of inattention to or disregard for one's own life, health, or property by engaging in behavior that increases the frequency or severity of a loss. A moral hazard is attitudinal and involves an apathetic disregard. An example of a moral hazard is an insured who has the option to drive on a paved road when leaving her home, but instead drives off road and on terrain that can cause damage to the body of her car. With this example, we can say that the insured has an apathetic disregard when it comes to damaging her car because she knows that her insurance policy will cover the damage. There are 5 methods of managing risk. The first is risk avoidance. Avoiding the hazard eliminates the risk. For example, to avoid the risk of an automobile accident or a house fire, a person can simply avoid the risk by not purchasing a car or a house. Risks can also be transferred. This is the most common and most popular method of handling risk. A person can transfer their risk to an insurance company in exchange for paying a regular premium to the company. However, when a risk is transferred to an insurance company, it is common to share some of the risk. For example, the deductible an insured pays when a claim is paid is a form of risk sharing. The insured accepts responsibility for a small portion of the risk while transferring the larger portion of the risk to the insurer. The next method of risk management is the assumption of risk. This is sometimes referred to as risk retention or self insurance. With the assumption of risk, an individual decides to create a risk by doing something such as purchasing a car or a home, and the purchaser retains the uncertainty of loss. This means that the individual would replace the car or house at their own expense if a loss occurred. The final method of risk management is risk reduction or risk control. Using this method, risks can be reduced by employing loss prevention methods, such as installing a sprinkler system in a building, no longer smoking cigarettes, or losing weight for health reasons. Underwriting is the process of selecting certain types of risks that have historically produced a profit and rejecting those risks that have historically produced a loss. Good underwriting practices normally produce a favorable loss ratio for an insurance company. This means the premium collected, minus the claims paid and operating expenses, produces a profit for the insurer. Insurers must carefully underwrite all risks to avoid being the victim of adverse selection. Adverse selection is the tendency of insurance, with a greater than average chance of loss, to purchase insurance. With adverse selection, the insurer is confronted with a possibility of loss due to risk factors that were not factored in at the time the policy was sold. Insurers can avoid adverse selection by pulling their risks from more than one source, thereby spreading the risk. This can be achieved by ensuring, during the same underwriting period, either a very large number of similar risks, multiple insured locations, or activities with dissimilar risks. When an insurance company is underwriting a policy, the primary source of information they use is the application itself. This is the reason it is so important for applicants to be honest on their insurance application. However, other underwriting sources are used, depending on the type of policy being underwritten. Those sources include, but are not limited to, consumer reports, inspection reports, credit reports, insurance maps, insurance company records, insurance industry statistics and reports. Insurance companies will sometimes use reinsurance as a means of reducing their loss exposure on a particular risk. Reinsurance is insurance purchased by an insurance company from another insurance company. Rather than one insurance company accepting the entire risk and possibly suffering a catastrophic loss, the risk is ceded to another insurance company or companies to spread the risk.